Welcome back, everybody. Today we are looking at the ES, and I would specifically like to focus on the PM session. And in this specific model, I will look at the AM session as a reference in time, and I will hunt for a PD array in the AM session, which I can then use in the PM session to frame a trading idea. So let's look at this piece of price action. This is a ES chart looking at a 15-minute time frame. We are referencing Wednesday the 17th. If we take a quick look at, let's look at the AM session, which starts around, for this specific example, let's use the 9:30 opening, but it does start as early as 7 o'clock in the morning. But I'm just going to reference the 9:30 opening to keep it nice and simple, keep things easy. And that is going to go up to about I'm going to go for around about 11 o'clock. And that's going to be my frame of time, just because I don't want to extend that time into the lunch. I really want to focus on a specific PD array that I would like to use that formed in the AM session. So you could take this beginning line and you could start that at 7 o'clock. If you wanted to do that, we could do that. That would be fine too. That would work perfectly fine as well. So let's just reference that for the start of the AM session. Very early AM session opening. AM session starting. And then we go up to 11 o'clock. That gives you a bit of a time frame, bit of a window that you can work within, and you can frame your PD array. All right. So I'm shifting up to a daily chart. First of all, and let's bring this into focus. We were expecting lower prices right off the bat. I posted these charts in the NAS specifically on Telegram, and they were posted on the Twitter page. If you followed along, then you would have received them there. So for this specific example, we have a bias on the daily time frame that is bearish, so we would be looking for lower prices, and we expect the lower time frames to give us confluences in line with that particular idea. So shifting that back down to a 15-minute time frame, I want to look at this specific example and notice that we tapped into this higher time frame level, trading inside of it, and we break down below this low. So in essence, this last down candle would be a breaker block with a high and a higher high. Trade through that, trade back to this candle's range, and that would be a tap into the breaker block. Now I am referencing, in this case, I will be referencing this specific candle, and I will use this candle as a order block. So that will be the order block over there. You can see we run down lower very impulsively, sharply, and we trade below this low as well as these ones over here. So that is another market structure shift. Let's go down to a lower time frame, Wednesday the 17th, and this is specifically We look for trading ideas in the PM session with this particular model or this framework. We would be looking for trading ideas in the PM session. So let's go back to this. Scrub back. Here we go. So as you can see, we trade up into this 15-minute order block. We tap into that. And from this point forward, you can utilize any one of ICT's PD arrays as an entry model. You could use a breaker block, you could use a mitigation block, you could use a fair value gap, an inversion, whatever you feel like you want to use and whatever makes the most sense to you. So if I look at this piece of price action, the first thing that stands out to me, if we want to target lower prices, then we have the side of the curve. So this to me looks like a classic sell program, market maker sell model. So we have these relatively equal lows in there. So that's going to be the first target. That's going to be the first target that I would aim for. And then from that point on, we have more equal lows over there. And we have all this low resistance liquidity run resting below us, which could be targets as we trade lower. For this specific idea, I see two consecutive up close candles, which would be an order block in this example, coupled with a balanced price range with this gap and this gap over here. So that is a balanced price range. We can just take note of this range. Marking that with a rectangle extended through, that's a balanced price range. So that would be what I would be looking at. And let's frame this trading idea. Short position. Your entry would have to be at this order block. So that would have to be somewhere around here. So let's say that we took an entry over there. And the stop in this case is going to have to be above this high because we have the order block, two consecutive up close candles, and we have this balanced price range. And we also have this fair value gap over there. So that is going to place my stop above the candle that formed the fair value gap, which is this one. So it's going to have to go above there. To give it a bit of a buffer, you can place it above the high, which that gives you a stop of about 9 handles, which that's not bad. Framing the risk to reward, we can target these lows. So that would be the first target, and then after that gets hit, you take a partial, and if you are able to keep another position in this trading idea, then you would be targeting these equal lows next, and after that you would be targeting these subsequent lows as price continues to trade down towards them. Time of day was still relevant, being 3 o'clock in the afternoon. So that would still be viable for you to stay in this position to see if price wants to give a last push down before the market closes, which as we can see in this case, it just went sideways and then small little push down lower before we closed which it's not worth holding through all of this over there. It's not worth it. It's better to you take something off at this first partial, take something off at the second one, and you're probably gonna be tagged if you have a trailed stop in profits. You would probably be trailing really closely if you had 2 targets hit already. So that's a nice risk to reward if I look at this first target of 1 to 2. And obviously, as we trade lower in this area over here, we also have, looking to the left, a fair value gap. We can frame this fair value gap. And we also have, trading down lower, we have this up close candle. That would be another order block, which once we trade through that, we can lower the stop and we can bring the stop above this fair value gap. And as price continues tanking down, we can put the stop right at the high of that candle over there. And as you can see, that gives you a very good risk to reward model, but ultimately the trade would be taken with this risk to reward of 9 handles, and you're aiming for around about 2%. That's a solid idea, clean trade, and that would be what you would be targeting, what you would be looking for as an example. Let's see if we can frame some more take profit ideas, and let me use this order block. And let's look at some extensions over here. Now this fib doesn't extend out far enough, but we can see the 3.5. You're probably going to be sitting at around 4 deviations of this order block down, projected down, and that would be your take profit. And you could also take the fib, and we can just measure this price range. If I expect price to run down all the way down here, this is the price range from low to high, then I can see that 50% is over there, and that gives me a discount level below these lows, and that's why it's ideal to take a profit below these lows. So that is how you would frame this idea. Let's take a look at the NASDAQ, and we were looking for initially this low and then this one, and I just had this order block noted on price as a pause, as this would provide a pause in the market. And we also have this overlapping inversion over there. So that's going to give a pause to these marketplace. All right. So we are expecting lower prices for the entirety of that week. So let's go down into a 15 and see if we can frame a setup. So let's look for one live. Let's see. This would be a very early PM session trading idea. I like the fact that we had these highs. We had these highs resting over here. We took out these highs. I like that idea. We just barely did not tap into this 15-minute order block. But I like the idea of this move down, this being a mitigation block. That's a beautiful mitigation block. And we just came and we tapped right into it right there. So that's going to be my framework for this trading idea. So that I'm looking at this mitigation block. See how we barely tapped into it right there. Barely tapped into it. And price ran down. We also had these stops. So that's going to be 15-minute buy stops. "15-minute buy stops ran over there. That frames a trading idea. I also saw this inversion level to the left. And as you can see, we barely tapped into that level as well. So that's another reference point that you can use to frame this trading idea. 19th of April. So let's go down into a lower time frame. It was Friday. So let's look at a lower time frame and let's frame this idea. Beautiful. There we go. Looking at a one minute. Here we go, 15-minute mitigation block. We just barely did, just almost didn't trade into that, but it's close enough to call it. So looking at this 1 minute chart, I can see we also took out this buy side liquidity resting above this high over here, as well as this one. So we had equal highs. Just barely a very early PM session trading idea. Now this specific one is a bit more advanced, as in this scenario we didn't really have an entry at this peak. It's possible to frame an entry at this peak, but that would be more advanced, and it's probably going to be likely that most of you won't be executing on that entry, but rather this massive fair value gap, and we traded back into that fair value gap. That is going to be the most probable entry for most of you guys. So to frame that, I'll just drop the fib on that. That's the mean threshold. This thing, let's see if I got these levels on here. If I have quadrants, let me just extend this out. So if you look at that and you put quadrants on this fair value gap, then you can see that we barely tap the 25%, which indicates that this is a very bearish price run and price is in a hurry to trade down lower. As far as framing targets, we have equal lows over here in this area. We have a low down here, and then my eye gets drawn to this fair value gap. We also have this low. If you held on to it, or you added a position there and you sat through this, then price offered you this extra run down. If you chose to hold on to it. Let's frame this idea. Short position, and the entry is going to be here. The stop in this case, we have the fair value gap. Overlapping the fair value gap, I have a beautiful inversion over here. As well as this big order block with all these up candles over here. So I have an inversion. I have a fair value gap. And another thing that I also see in this specific area is that we have this wick and we have this tail. And if you remember the I fair value gap from ICT is that you take the 50% of this wick, you mark this up, and you take the 50% of this wick and you mark that up. And let's choose a different color so we don't get these colors confused. Let's say green for the sake of clarity. Green. There we go. So that would be an I fair value gap. And essentially this is another fair value gap that price could trade up into, and it could stop there. Notice that the middle of this is also 75% of this fair value gap. So those are extra confluences, and this gives me 1, 2, 3 PD arrays. So if you take this trade, the stop would have to be above the high that formed the fair value gap, which is this candle over here. So the stop would have to be above that there. So that's going to be the stop loss, 20%. Let's shift this over. Targets. In this case, if you're looking for a 1 to 2, then you will have to reach down lower for this fair value gap in order to see that return. You're going to get a 1 to 8. Now again, we're going to apply the same theory where once price rallies down aggressively, we will bring the stop above this I fair value gap. And as it continues to drop down lower, we have an order block, fair value gap. We can eventually place the stop loss above that area. As we trade through this and we take a partial, then the stop ideally should come down, and price shouldn't be trading above this as well as this fair value gap again. It should run down for its targets, which it did in this case. So that's a little model of how we will utilize something from the AM session. By the way, let's just go back up into the 15, scrub this over. And in this example, I did not mark out the range, but we all know that the range is from 7 up to 11 o'clock. And that would be the mitigation block at 10:15, by the way. So essentially what we're looking for is higher time frame directional bias. Number one, if you don't have the bias, then there is no trading idea. You need to know where price is going to draw to in reference to your higher time frame, and then you look at what PDRA's price action gives you in the AM session, and you reference back to those in the PM. And ideally, you look for a continuation trade in the same direction as your higher time frame draw on liquidity. Hopefully, this model will be a tool in your library if you're not able to trade in the AM session, or perhaps you prefer to trade in the PM session. At times, the PM session could be a bit easier to trade just because we use that as a continuation model. And we'll look at what has already happened in the morning, and we just follow suit with that and look for something in line with the higher time frame directional bias. Most importantly, we reference time. Time is the most important thing. Hopefully you found this one insightful, and hopefully you have learned something. And until the next one, good luck and be safe.